Whether you're feeling stressed out by a high-pressure job or just dreaming of a different lifestyle, getting ready for retirement sooner rather than later is a very wise money move. Most people qualify for Social Security benefits as early as 62, and some get pensions from their old jobs. But you typically also need your own assets to fund a comfortable retirement. Building a nest egg means investing regularly with enough growth to cover your estimated future expenses after you no longer earn an income. But what if you've been a good saver and you're thinking about early retirement? Well, this podcast will review tips for knowing if you can retire early and how to avoid paying hefty penalties when tapping a retirement account early. Hey friends, welcome back. I'm Laura Adams, an award-winning author, money speaker, founder of the Money Stack newsletter, and host of the Money Girl podcast with 43 million downloads. As an on-camera financial spokesperson and content creator, I partner with select brands for PR and marketing work. As always, you can learn more and use my contact page at lauradadams.com. And while you're there, if you sign up for the Money Stack newsletter, you will get information about my upcoming workshop called Smart Investing Masterclass: How to Make Money and Achieve Financial Freedom While You Sleep. I hope you will join me and register for this upcoming live event. Achieving an quote-unquote early retirement really depends on how you define it. You know, you may want to retire from your current job by working part-time in the same field or even for the same company. Or you may want to start a more fulfilling but less lucrative career. Early retirement could also mean working for yourself, starting a business that you've always wanted. It could mean volunteering or relocating to a less expensive country that allows you to stretch a dollar. I know a lot of Americans are doing that. So I encourage everyone to aim for early retirement. Then, if you're healthy enough to continue earning an income into your 60s, 70s, or beyond, you can build even more financial security if needed. But knowing if or when you can start earning less or stop working altogether is really more of an art than a science. So we're going to go through 6 steps that will help you tell if early retirement is possible for you. So the first step is to estimate your retirement spending. This is so important because, that number is going to really determine how much you need to have saved. So you want to start by adding up your current expenses. So all of your living expenses, your housing, your food, insurance, medical bills, and transportation. Now, if you believe that your mortgage will be paid off by the time you retire, you could back out that mortgage payment. But, you still will likely have property taxes and homeowners insurance. So start to really think about what expenses you have today that you will or you won't have in retirement. Some of your expenses will likely decrease in retirement, but many, like your hobbies, travel, and healthcare, could go up. They could go up significantly. Remember that you don't qualify for Medicare health benefits until you are age 65. So be sure to budget for health insurance, which can be surprisingly expensive. And you need to factor a typical inflation rate, such as 2% or 3%, into all your average costs for retirement. While you can't know precisely what inflation will be or what you're going to spend in the future, you do need an estimated budget to determine your retirement savings target, which is the next step. So step 2 is to know your retirement savings target. Once you've estimated your retirement spending, let's say it's $100,000 a year, you can calculate your target savings goal based on that number. Now, this is going to depend on many factors, including the age you retire, your life expectancy, so how long you're going to need an income, how much you plan to spend or withdraw from your investments in retirement, how much income you might earn in retirement if you plan on doing any part-time or full-time work, your average pre-retirement investment return, your average post-retirement investment return, and your home state. Every state is different in terms of the income taxes it charges or doesn't charge, and things like sales tax and just general cost of living. As I mentioned, the earliest you can begin collecting Social Security retirement benefits is 62. So until that time, your savings and maybe any pension income that you qualify for, they have to generate all your income. A mistake many early retirees make is withdrawing too much from their investments and then having to return to work later on. A general rule is that when you retire at a typical age, so let's say in your 60s, withdrawing 4%, maybe up to 5% annually from your investment portfolio should ensure you never run out of money. But that also does depend on the benefits you're getting from Social Security and any pension or annuity income you have. But early retirees typically can only withdraw less, like 2% or 3%, depending on their age and their ability to earn an income in the future in order to make their nest egg last a lifetime. For example, if you want to retire at 50 and believe you'll live until age 90, you're going to need income for 40 years. Your income in early retirement would come exclusively from your investments. So let's say from age 50 to age 62 if you take early Social Security. Or if you delay Social Security to 70 when your benefit will be as high as possible, you would be withdrawing income from your investments from age 50 to age 70. And of course, adding in any pension or annuity income you may have. But let's say you need $100,000 a year from your investments, and we're going to assume a 2% withdrawal rate. That would require a $5 million portfolio. So you would take $100,000 of income, divide that by 2%, you get a $5 million portfolio. However, if you have a pension that pays $60,000 a year starting at age 50, you would only need to withdraw $40,000 from your investments. Using a 2% withdrawal rate, that means you would only need a $2 million nest egg, only a $2 million nest egg. It's possible that you could withdraw a higher percentage. You could take out more from your portfolio if your Social Security benefit is significant, or you've got a significant pension to lean on, or maybe you relocate to a low-cost country, or you expect to receive a really nice inheritance. So there are a lot of factors that go into your target savings number. And step 3 is to invest early and consistently. So if you want to retire early, but maybe you're struggling right now to build an investment portfolio, the trick is starting early and being consistent for as long as possible. And if you haven't gotten started investing, please don't wait for the quote right time to invest, because it doesn't exist. No matter what's happening in the financial markets, your money can't grow if you sit on the sidelines. We always say your time in the market is way more important than trying to time the market. Every day of investment growth matters, especially when you want an extra large nest egg to retire early. My favorite way to invest is to put it on autopilot, so I just don't even have to think about it. With any investment account, you can set up automatic contributions on a schedule, such as weekly or monthly, and try to increase your savings rate until it hurts and then reach a little higher. For example, if you're investing 5% of your income, see if you can push yourself to invest 10% of your income by the end of the year, or maybe, increase it by 1% every month. Some investing platforms can even automate your savings increases so they happen on specific dates, such as on January 1st. If you plan to retire early, don't miss episode 829 called 5 Steps to Achieve FIRE, and that stands for Financial Independence Retire Early. In that show, I talk about various saving strategies for early retirement. To accumulate enough for early retirement, you're going to need to save aggressively, such as investing at least 20, maybe even up to 25% of your income, just, again, depending on your goals. So consider reducing unnecessary costs and cutting your high expenses that are in your budget. See if you can cut your housing, see if you can cut your vehicle expenses so you're freeing up more money to invest now. You can also create extra income by starting a side business or getting a second job so you can consistently boost your retirement account. Early retirement is an aggressive goal, and you gotta pursue it with gusto if you're really serious about it. It's not going to be easy, but it is possible. Step number 4 is to use tax-advantaged retirement accounts. To save more and protect your future investment earnings, I always encourage you to use tax-advantaged accounts such as workplace retirement plans, IRAs, and health savings accounts, or HSAs. All these accounts were designed to help you save and reduce your taxes simultaneously. With a traditional retirement account, like a traditional 401k or a traditional IRA, your contributions are made pre-tax. So you pay taxes later on when you take future withdrawals of those contributions and earnings. If you use a Roth account, like a Roth 401k or a Roth IRA, your contributions are taxed up front, but withdrawals of contributions and earnings are generally tax-free. So having tax-free accounts to withdraw from in early retirement will leave you with a lot more money to spend. You're not going to have to share that retirement nest egg with the government if you've got Roth accounts. The allowable contribution limits for various tax-advantaged accounts are going to increase with the cost of living index, so you want to check each year for the maximum amount and plan to hit it. If you max out these accounts first, you're going to get the biggest bang for your buck. Also, when thinking about taxes, you want to claim as many legitimate tax deductions and credits as possible each year to save money. These might include deductions for home mortgage interest, student loan interest, state and local taxes, charitable contributions, medical expenses, above a certain amount, child tax credits, etc. So working with a qualified tax accountant to maximize your savings and minimize your taxes can really pay off. If you need clarification on tax-related expenses, or maybe you've got a complex situation because you own a business or a rental property, I definitely recommend consulting a tax professional. All right, the fifth step is to understand retirement account rules. So as you get closer to retirement, you really need to know, where's this money going to come from? Tapping a retirement account before age 59 and a half typically comes with a 10% early withdrawal penalty. And a huge benefit of using a Roth account is that withdrawals of your original after-tax contributions are always tax and penalty free, no matter your age. So that really makes Roth accounts an excellent option for early retirees. However, your investment gains in a Roth have not been taxed. So if you withdraw earnings from a Roth before age 59 and a half, those amounts would be subject to tax plus the 10% penalty. Now, there is a really great exception if you have a workplace retirement plan and you want to retire earlier than age 59 and a half. It's called the Rule of 55. So how this works is you can take penalty-free withdrawals from your 401k or your 403b after reaching age 55, but it's once you're no longer employed. So note that this rule does not apply to IRAs. It only applies to workplace plans and solo 401ks. So what happens is you need to leave the funds with your former employer's retirement plan at least until you turn age 59 and a half. Then you could do an IRA rollover, and take your withdrawals from that point from the IRA. But remember that if you want to use the rule of 55, those funds, have to come from the workplace plan. And for specific government workers, penalty-free withdrawals are allowed as early as age 50. And if you have a 457 plan, there is no withdrawal penalty regardless of age. So that makes that plan a really good one for early retirees. However, remember, any amounts not previously taxed are always subject to income taxes. All right, and our last step, and this might be maybe the most important one to understand if you're thinking about an early retirement, is to consider a 72T payment plan. So this is a little known rule that allows you to avoid the early withdrawal penalty that I've been talking about, regardless of age. This exception goes by a few different names, including 72T payment plan, 72T distribution, and substantially equal periodic payments, or SEPP. The 72T comes from its numbered section of the IRS code, and the regulation allows you to set up a plan to take equal monthly or even annual distributions from your retirement account. It could be a traditional or a Roth IRA. It could also be set up for a workplace plan like a 401k or a 403b if you no longer work for your employer. And the amount you can withdraw using a 72T plan gets calculated using a accounting method approved by the IRS. And it's going to look at your account balance, your age, and your life expectancy. And the payment calculation can be based on the amount in a single retirement account or the aggregate of all your accounts. I want you to be aware that using a 72T plan has negative financial consequences if you don't use it correctly. Once you begin taking 72T distributions, you must take those payments for at least 5 years or until you turn 59 and a half, whichever is longer. In other words, if you start a 72T at age 50, you have to continue those payments for 9.5 years until you reach age 59 and a half. But after you complete a series of 5-year distributions or you reach age 59 and a half, you can take retirement distributions any way you like. So basically, you can stop that 72T plan and, take distributions as you wish. However, for most traditional accounts, remember that once you reach age 72 or 73, depending on your birthday, you generally must take annual required minimum distributions, whether you used a 72T plan or not. Another consideration is that you can't make new contributions to your retirement account or add any rollovers while you take 72T payments. And of course, all distributions that were not previously taxed with a 72T would be subject to ordinary income tax. Setting up a 72T payment plan is an excellent way to tap your retirement funds early without a penalty, no matter your age. However, figuring out the allowable payment schedule can get a little complex, so you definitely want to get help from a qualified tax professional. If your 72T distribution is too large or is too small, you may be subject to not only to income taxes, but a 10% early withdrawal penalty and interest calculated from the original date you made an error. So you need to make sure that you're handling a 72T correctly. And before starting a 72T, be sure you can afford the immediate cash flow and still have a nest egg that's going to last a lifetime. So be sure to get help from a financial advisor or a CPA if you're considering a 72T payment plan, or really just in general if you're thinking about early retirement. As I mentioned, there are a lot of complex calculations that you need to factor in to understand if you can successfully retire early, and really understand what is the lifestyle that you're going to be able to sustain. And it's not a decision to take lightly. It's certainly something that's not easy to achieve, but it is definitely possible. So I hope this has been helpful. I really thank you for listening. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our fantastic team. Steve Rickyberg audio engineers the show. Brandon Gachus is our director of podcast. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. And Davina Tomlin is our marketing and publicity associate.